Hi, I'm Ed.
And I'm Will.
We're the officials, and we publish fair value curves at the close of Singapore and Europe sessions every day. Now, today we're going to be diving into a bit of a controversial development that we've seen this week regarding the Dubai and Murban pricing methodology that's had a bit of a proposed update. So, Will, could you just explain really how the current system works and what the change will involve?
Yeah, so throughout trading recently, there's been a quality premium associated with Murban, which is unidirectional, i.e. if Murban is pricing above Oman, then the seller has to be compensated the difference because obviously it's traded at Dubai, and Dubai, if it's pricing under, then they're at a discount. So the quality premium adjustment obviously became a little bit problematic when Murban was starting to price under Dubai and set the floor of Dubai. That has led to Platts kind of reviewing their methodology, and now they've introduced a two-sided price adjustment. So they're calling it a quality adjustment. And that means that Murban can now trade at a discount. That can be a negative quality premium associated. And
that, instead of being the buyer being compensated, it would be the seller.
The buyer.
The seller would have to compensate the buyer for providing this grade into the Platts mechanism.
Exactly. So that would effectively mean that if Dubai was trading at 70 and I declared you a Murban cargo, after we've exchanged quality premiums, that Murban could be traded cheaper than Dubai. So what's actually new here is under the current quality premium model, the adjustment only works in one direction. So now we have a bi-directional quality adjustment, but it's not symmetric. Currently, under the quality premium, if the adjustment is effectively 50% of the spread between Murban and Oman when that spread is greater than $1.
And when Murban is pricing above Oman only.
Exactly.
This is the important adjustment.
Exactly. So when it's a premium, it's 50% of that adjustment. But the adjustment when it's a discount, so when it's a negative quality premium, is 100% and not capped at all. So it's 100%. The seller has to pay 100% of the spread with no threshold. So in effect, sellers are taking the full downside risk here, and only partial upside reward. So that's a bit of inequity there.
And then if you're holding a Murban cargo, you're disincentivized from declaring Murban into the window because as the seller, you could get hit with this negative quality premium, which will massively disadvantage you. So you get hit doubly because you've got a cheap Murban to declare into the Dubai complex, and you've got to then compensate for the quality premium. So this creates this kind of skew directionally because you're never incentivized to declare a Murban when it's pricing cheaply.
And even when it's not pricing cheaply relative to Dubai, just relative to Oman. And then and that kind of brings it into the next issue, which is that brings in a whole host of exogenous factors into the pricing mechanism, which weren't there before from Oman's pricing, depending on how Oman prices. I mean, do you want to talk a little bit about that?
So because the spread is measured as the spread between Murban and Oman, if you have, say, Oman pricing at 71 and Dubai being set at 70, even if Murban is pricing between them at 70.50, although it's pricing above the Dubai pricing, it is still going to be subject to this negative quality premium because it's below Oman. So you have this kind of disconnection between Murban and Dubai because it is now being influenced more heavily by the Oman pricing. So this brings in all these other factors that affect Oman specifically into the Murban pricing, and it makes it all a lot messier.
Especially at the end of the month, as you can see on the accompanying chart, Oman pricing can get pretty volatile. There's a whole host of pretty idiosyncratic, pretty strange pricing mechanisms that are layered on top of the Oman pricing contract. So you have mechanisms upon mechanisms which can lead to excess volatility, which then, of course, can feed back into Murban's pricing and how that price is out in the window.
And one of the main reasons that Murban was added to the Dubai benchmark as a deliverable grade is that it was intended to boost liquidity, right? Because Murban is a big field; it produces a lot of barrels, and the point of that was, as I said, to increase liquidity within the benchmark to improve its functioning. However, when you're effectively, as a seller, being penalized for declaring Murban, that suddenly cuts down on the liquidity benefit of adding Murban in the first place. So there's this whole liquidity aspect to it, the pricing aspect. It becomes a lot more complicated, and there's
and Oman is of course much easier to squeeze than Murban
because it's so much smaller.
Production is so much smaller, so you could have Oman printing really quite strong on thin liquidity, and that passing through into Murban and making that look relatively cheap, even though it is still
there's the other
mentally.
There's also the added complication of the GME Oman contract, which is a physically delivered contract. So like with all the controversy recently about the IFAD physically delivered Murban futures contract, you could, in theory, squeeze the futures contracts on the GME exchange, the Gulf Mercantile Exchange, and that could boost the Oman pricing, which would then obviously have this effect by bringing in the negative quality premium on Murban. So where you've got the physically delivered cargo, the physically delivered futures contracts, it adds a layer of complication because this quality premium only comes into effect in the Platts pricing mechanism, because it's the Platts methodology for their window system, and that means it's open to these kind of external factors, as you said, such as the exchange trading and the physical deliveries in there.
So let's just run it through with an example. So say Dubai is trading at $70, say Oman is trading at 70.60, and Murban is at 70.30. Murban is clearly premium to Dubai in this example, it's 30 cents. But then the seller will have to adjust for the Oman to Murban differential. So the seller pays 30 cents in adjustment, and the buyer then receives that compensation. And in this scenario, Murban would just about be deliverable. But let's say you extend that. So now instead, the seller has to pay a 40 cents adjustment. So instead of Murban, instead of Oman trading at 70.60, it's trading at 70.70. In this scenario, Murban's now pricing under Dubai. So there's a direct incentive not to deliver any Murban in this scenario. So that's going to reduce liquidity. The whole, as you're saying, the whole point of introducing Murban was boosting liquidity. And this goes directly against that.
One of the other aspects to consider is the way that they determine in this mechanism when Murban is pricing below Oman. Because in the proposed change, it will be on an average basis of the 5 previous trading days. So if Murban has priced on an average basis below Oman over those 5 days, you will then, this quality premium, negative quality premium, will come into effect. And it means it's a retrospective influence. And the problem comes particularly at the end of the month, because we're in July now, so we're trading September barrels. However, at the beginning of August trading, we'll be trading for October barrels. So the 5 days prior could easily be 5 trading days in July, which means that you're comparing pricing for September delivery barrels in order to influence the quality adjustment for October delivery barrels. So there's this whole disconnection in terms of the actual application of the quality adjustment factor, which comes in as a result of the roll from month to month.
Exactly. So then in terms of what we can expect from the benchmark in terms of pricing, this adjustment, I think, is pretty clear. It has an upward bias. It favors the longs, which is kind of counterintuitive for benchmarks in general. I think
they're supposed to be neutral, and
neutrality is
a useful flat.
It's a key concept in benchmark construction. So I think a lot of people would expect the Dubai benchmark to rise if these changes do come through. Platts are asking for comments by
until August, early August, and then the proposed change would come into effect according to this schedule in January. So we have a few months to work out the details before that. But
so just to wrap up, the new changes, they bring in a symmetry in how premiums and discounts are applied. Also, the reliance on Oman as the benchmark anchor.
It's a bit problematic because it muddies the Murban pricing with the Oman factors.
And then filters into the Dubai mechanism
exactly.
more broadly. And then thirdly, handling of the roll of months. It contaminates the new month with lagged data. Just to wrap up, provide a quick summary. Firstly, we've discussed the adjustments to the Platts pricing mechanism for Murban. They've introduced this asymmetric quality adjustment, which favors the longs, introduces a positive bias, as we've discussed. Secondly, we've discussed how Oman has been used as an anchor to that quality adjustment, which brings in a whole host of exogenous issues. And we've discussed how rolling months could be problematic. We'll keep you updated with any further developments on the story.
So make sure to stay tuned to our Twitter channel at Onyx Officials, to Jorge's LinkedIn for the daily reports, and we'll see you in the next video. Thank you.
Thanks for watching.